Picture this. It's 2008, and a 158-year-old financial titan, a pillar of Wall Street, just vanishes. Overnight. Its collapse didn't just make headlines, it triggered a global meltdown. The worst since the Great Depression. Trillions in wealth gone, millions of jobs lost. The world economy pushed right to the edge of the abyss. We all know the story of the crash. But what if I told you that was just Act 1? We found the secret script that led to the whole disaster, and the chilling part? Its final act might be playing out right now, in 2026. So, how did the world break? To get it, we have to rewind to the early 2000s. The dot-com bubble had just burst, and the US Federal Reserve, led by Alan Greenspan, was desperate to keep the economy from sinking. Their big idea? Slash interest rates. By 2003, they hit a historic low of just 1%. Suddenly, borrowing money was almost free, and all that cheap money needed somewhere to go. That somewhere was the US housing market. With loans this cheap, the American dream felt like it was on sale. A full-blown housing frenzy kicked off. Between 2000 and its peak in mid-2006, home prices went ballistic. This wasn't just a hot market. It was a bubble, and it was being pumped full of air by a new, dangerously reckless kind of finance. Wall Street, forever hungry for bigger profits, started playing a very dangerous game. Lenders began pushing subprime mortgages. These were loans for borrowers with shaky credit, often with zero down payment. They weren't safe bets. They were ticking time bombs. Most came with a low teaser, interest rate that would eventually explode into a much higher payment that many homeowners simply couldn't afford. But here's where the script gets truly insane. The banks didn't just hold on to these risky loans. They bundled thousands of them together into complicated products called mortgage-backed securities, MBS. Then, they sliced and diced those into even more complex structures called collateralized debt obligations, or CDOs. Think of it this way. A single bad mortgage is like a rotten tomato. You can spot it and throw it out. But Wall Street took thousands of rotten tomatoes, blended them up with a few good ones, and sold the resulting juice in a fancy bottle with a premium label. And the watchdogs? The people who were supposed to protect the system? The rating agencies stamped these toxic bottles with AAA ratings, the highest grade possible, calling them as safe as government bonds. And everyone bought them. Pension funds in Norway, city governments in Australia, banks all over the world. It was a system built on a lie, fueled by greed, and a total failure of common sense. Federal policies from giants like Fannie Mae and Freddie Mac, meant to encourage homeownership, only made things worse by creating a false sense of security and encouraging the purchase of these risky loans. By 2006, the party started to go bad. The Fed, now worried about inflation, began raising interest rates. For all those homeowners with subprime mortgages, the bomb went off. Their payments skyrocketed, and they couldn't afford their homes anymore. Defaults started to spike. The first real tremor hit on April 2, 2007, when New Century Financial, a massive subprime lender, went bankrupt. That was the canary in the coal mine. As home prices fell through 2007, all those safe, rated securities that banks held were suddenly exposed for what they were: worthless. The first big casualty on Wall Street fell in March 2008. Bear Stearns, a legendary investment bank, was about to collapse, drowning in its subprime bets. The Fed had to step in and engineer a fire sale to JP Morgan Chase just to stop a full-blown panic. The financial world was officially cracking, but the real earthquake was still to come. The summer of 2008 was a season of pure fear. In July, IndyMac Bank failed in one of the biggest bank collapses in US history. Then, the two giants of the housing market, Fannie Mae and Freddie Mac, who backed trillions in mortgages, started to buckle. On September 7th, the US government had no choice but to seize them in a massive bailout to keep them from imploding. Everyone held their breath. Which domino would fall next? And then it happened. On September 15, 2008, Lehman Brothers, a 158-year-old giant, filed for bankruptcy. This time there was no rescue. The government, afraid of encouraging more bad behavior, let it fail. Lehman's collapse was the point of no return. It triggered pure, unfiltered panic. The credit markets, the entire circulatory system of the global economy, froze solid. Nobody knew who was holding Lehman's toxic junk, so banks just stopped lending to anyone, including each other. A major money market fund called the Reserve Primary Fund broke the buck, meaning its value dropped below $1 per share. This may sound small, but it shattered confidence and started a massive run on money market funds, which millions of people thought were as safe as cash. The whole financial system was having a heart attack. The chaos went global instantly. The very next day, the government was forced to do a complete 180 and bail out insurance giant AIG with an $85 billion loan. They called AIG too big to fail because its collapse would have taken the entire system down with it. Bank of America scrambled to buy a collapsing Merrill Lynch. The global financial system was staring into the abyss. In a desperate move, the US government proposed a $700 billion bailout called the Troubled Asset Relief Program, or TARP, to buy up the toxic assets that were poisoning the banks. The stock market absolutely cratered, with the Dow Jones dropping nearly 800 points in one day as the world watched in horror. The script for the end of the world wasn't a secret anymore. It was playing out live on every screen on the planet. The crisis left a deep scar on the world. The S&P 500 lost over half its value. Millions of people lost their jobs, their homes, and their life savings. It was the worst economic disaster since the 1930s. In the years that followed, governments fought back. They slashed interest rates to zero, fired up massive money-printing programs called quantitative easing, and passed sweeping new regulations like the Dodd-Frank Act to try and stop it from ever happening again. But did we really learn our lesson? The core problem of too big to fail never went away. The crisis was caused by insane risk-taking, and after the bailouts, the lesson many on Wall Street took away was, if you get big enough, the government will always be there to save you from your own mistakes. And maybe the biggest lesson we missed was that risk never really disappears, it just moves. Regulators cracked down hard on traditional banks. So the risk just packed its bags and moved into the shadows. And that brings us to today, 2026. The echoes of 2008 are getting uncomfortably loud. The first echo? Commercial real estate, or CRE. In 2008, the bubble was in houses. Today, the concern is in the office towers and shopping malls left half empty by remote work and online shopping. Office vacancy rates have been hovering near historic highs, and hundreds of billions in CRE loans are coming due. Many of these buildings won't be able to refinance their debt, creating a slow-motion train wreck for the regional banks that hold a huge chunk of it. The second, and maybe more dangerous, parallel is the explosion of shadow banking. This is a huge, less regulated network of private credit funds and non-bank lenders. After 2008, when the rules for banks got tougher, this shadow system took over, growing into a multi-trillion-dollar industry. This isn't all bad, but it means a massive part of our financial world is operating with less transparency, making it hard to see where the next bomb might be ticking. Finally, we have the bubble dynamics. The post-pandemic era, just like the early 2000s, was flooded with cheap money from low interest rates and government stimulus. This has inflated new potential bubbles. Some analysts are pointing to the incredible hype around AI, worried it has created a stock market bubble that could pop. On top of that, a massive maturity wall of corporate and government debt is set to hit in 2026, all of which will need to be refinanced at much higher interest rates. The script from 2008 taught us that crises are born when greed, complexity, and a stunning lack of oversight collide. Today, the characters and the setting have changed, but the plot feels eerily familiar. Being informed isn't about causing a panic. It's about being prepared. If you want to keep making sense of our complex financial world and understand the risks and opportunities that are right around the corner, make sure you subscribe and hit that notification bell. The 2008 financial crisis wasn't a freak accident. It was the predictable ending to a story where the system itself encouraged reckless behavior. The reforms that followed made the big banks safer, but they didn't get rid of risk. The threats just changed their address, moving from subprime homes to commercial real estate, and from regulated banks to the vast, murky world of private credit. Nobody can say for sure if or when the next crisis will hit. History doesn't repeat itself, but as the saying goes, it often rhymes. The warning signs are flashing again, from wobbly real estate markets to the hidden dangers in the financial shadows. 18 years ago, the world paid a brutal price for ignoring the script. The question for 2026 is, are we about to make the same mistake all over again?